Okay. Okay. Good evening, everyone. Thanks for your time for joining. Today we'll be looking at audit approach, or we call it audit strategy. What do we mean by audit approach, or what do we call audit strategy? Now, audit approach has to do with all the method to be used by the auditor during the audit to arrive at or to achieve an audit engagement. So audit approach is the overall audit strategy that will be applied by the auditor in order to achieve the audit objective. That is audit approach. All right. Sometimes they call it audit strategy. Now, it has to do with the the overall strategy the auditor wants to deploy during the audit engagement. So we call it audit approach. Okay. Now, what are the things that the auditor needs to do? The auditor needs to ensure, please mute your mic, please. Mute your mic, please. Mute your mic, please. Thank you. Okay, I was saying that is the totality of all the strategies the auditor will deploy during an audit engagement to be able to achieve the objective. Okay, please mute your mic, Remy. Oluremi, please mute your mic. Oluremi, please mute your mic. Please mute your mic, please. Oluremi.
Okay, all right, sir. I'll do that.
Okay, so I was saying that when the auditor wants to embark on an audit engagement, we've discussed that it starts with the letter of engagement. Once he has signed up the letter of engagement with the client, then the engagement starts proper. Okay, now before he draws up his audit plan, he must have a strategy that he wants to use. So a strategy is a way or how he wants to go about the engagement. So after he has drawn up his strategy, in his strategy is where you have the what? The audit plan. So the audit plan is embedded in the what? In the strategy. Okay? So that's how it goes. So after the strategy, you have the audit plan. Then after you have drawn up the audit plan, then you now go about how you are going to obtain or gather all the sufficient and appropriate audit evidence. Now, after you have gathered all the sufficient and appropriate audit evidence, you are now going to evaluate them. You are going to evaluate and review the audit evidence that you have gathered to be sure that, so that when you are writing your audit report will only contain all sufficient and appropriate audit evidence relevant to the engagement, and you are done with the audit engagement. You will have achieved the audit engagement or the audit objective. Okay, so what we are saying here is that this strategy entails how the auditor wants to go about the engagement. All right? Now, the auditor should consider the responsibilities as defined in the letter of engagement. Then the next thing he needs to do is to familiarize himself with the client's business and organization, because you cannot audit what you don't understand. So you have to get yourself familiar with how the business process operates. Then the next thing you also need to do is to carry out what we call a preliminary audit risk assessment. For you to draw up your audit plan, you must have drawn up. Oduremi, please mute your mic. It's interfering. Oluremi, please mute your mic. So before he draws up his audit strategy or audit approach, he must have carried out what we call a preliminary audit risk assessment of the client business. be able to have an oversight or an overview of what is obtainable within the organization. Okay? So it is from there you're able to determine and record the audit strategy to be what? To be adopted. So the other thing is need to do is to look at what are those controls that are in place within the organization, internal control. What are the internal control systems that are in place within the organization? All right. Then you also need to evaluate how the accounting system, whether it is reliable, because there are some accounting systems that are not reliable when you use them, especially for some kind of business that you operate. Okay, so therefore we need to evaluate the existing accounting system to see that is what it is reliable, because it's from the accounting system you'll be able to obtain sufficient and appropriate audit evidence that is needed for that particular engagement. Then, when you observe there are any weaknesses within the organization, both in internal control and accounting system, you will communicate, okay, with the client and ask for if they are what we call compensating controls. What do you mean by compensating control? That is where the initial control fails. You have other controls that will support, okay, that will support those weak areas in the existing internal control system. We call it compensating controls. So yes, you do have the initial control, but do you have other secondary controls that you can use to mitigate when there are where there are weaknesses? For instance, you have a biometrics for attendance to be able to track punctuality of staff. Now, what if there is no light? Or what if suddenly the biometric register goes bad? Then you need to go for what? Your manual register. So your manual register is what we call what? Compensating control in that regard. Or you want to generate an LPO, local purchase order, which is automatically generated from the accounting system. So what if there is an issue with the accounting system that you need to create an LPO, but you cannot create it because the system is malfunctioning? Then you should have what we call a manual LPO that will suffice for the meantime while the account system is not functioning. That's what we mean by compensating controls. Okay. Then the auditor, we also need to check whether for the period that they are auditing, that the system operation or the system controls are perfectly in order. Then he also needs to ensure that any weakness in the internal control are documented and they are sent to or submitted or presented to the management. So those weaknesses are contained in a letter known as what? Management letter, or we call it letter of weakness. The two names that you can call it, either you call it management letter or you call it letter of weakness. Why is it called management letter? Because it's usually addressed to the management. Then why is it called letter of weakness? Because it contains weaknesses in the internal control system. What are some of the weaknesses? Let me give you insights of internal weaknesses in the internal control system. For instance, you discover that your clients in their system, they don't carry out what we call bank reconciliation statement. That is, they cannot establish how much comes in and how much goes out on a daily basis and a monthly basis like that. They cannot establish. So because of that, what we auditor will do is that it's going to highlight this as a weakness in the internal control. Because internal control is supposed to guide and prevent against what? Fraud. So what if somebody has been taking money from the company's account illegally? How would you have known when you don't do bank reconciliation statement? That is an example of what? A weakness in the internal control. Hope you are getting it. So those are the things there are some of the things that will be included in that management letter that will be presented to the client at the end of the engagement. Okay? So all of these and much more are what the auditor will do during the time he's trying to develop the audit strategy. Now, when he's developing the audit strategy, he needs to be sure that the organization, he has an understanding of how the organization operates. All right? He has an understanding of how the organization was operate. So you should be able to give an insight as to what is obtainable within the what organization. All right. So there are some activities that you will need to partake in. So aside from the first thing that he needs to do, which I call the preliminary audit risk assessment, he needs to partake in some other activities, such as what? Stock taking. He needs to take part in what? Stock taking. He needs to get himself involved in circularizing the company's debtors. What do you mean by stock taking? Now, at certain time in a month or in an organization, in a year or period, the organization is if they are into production, they will need to do what we call stock counts or stock taking. So you want to establish how much stock you have in hand at a particular point in time. So usually these stock counts are usually done at the end of the last day of the month or the first day of a new month, depending on what policy that exists or applicable within an organization. Okay? Because stock, your inventory, is part of your what? Balance sheet item. That is your statement of financial position item. And you have it in your statement of financial position. So the figure you have in statement of financial position must be correct. And that should take cognizance of what? The balances you have as at the stock count. Okay? Also, there are times when you also need to circularize your debtors. You have sold some items, some goods, some finished goods on credit to your customers. And some of these outstanding debts or receivables, they are yet to be collected. So what do you do? The auditor has looked at the financial statement. He saw where they put the balances in the debtors, or we call it account receivable balances. The auditor will not take everything there as accurate. What will he do? He will request for the list of all the company's debtors. Then he's not going to use the company's letterheaded paper to write to all the company's debtors to confirm the amount they are owing the company. So at the end of the day, they will oblige the request by sending in their balances they have with the company. Then the auditor will collate everything together and compare with what they have put in the statement of financial position as account receivable balances. That's what we call secularization of debtors. Okay, I hope we are getting it. Then the next thing he also needs to do, he has some of things he also needs to do is to ensure that he's in consonance or is familiar with different new trends, new development within the what? The legal system or legal environment. He ensures that he's within the what? He understands what is obtainable within the what? Business legal environment. For instance, there has been some new laws that have been reenacted in a couple of months within this year started. So it's the duty of the auditor to be able to explain to the client the benefit or how those laws will impact on their what? On their business. So it needs to be conversant with those changes, those developments. Okay? Then other things he needs to do is that we need to also ask the client, has there been any change since the last audit? For instance, at the last audit, they only had one branch in Lagos, and the headquarters is also in Lagos. But between that last year and this year, they have established three more new branches across Nigeria. So these are some of the changes that the auditor will expect information from management to buttress. Okay? Then also, you will need to also look at what we call analytical review procedures. What do you mean by analytical review procedure? So analytical review means that it will need to evaluate some key financial ratios to be sure that the business is still operating at the required minimum standard. Okay? So what I'm saying here is that there are some key financial ratios that are indicators of whether the company is doing well or the company is doing badly. So those financial ratios, they serve as what? Indicators about the well-being of the organization. So since the auditor has the information about the financial statements, he will compute those key financial ratios and compare them with what? With industry standard. So with industry standard, if it's below the industry standard, the regulator will tell them that the company, the way it's going, is going to fail at some point. And if they are doing above the industry standard, the auditor will say that, oh, they are doing well and they can still there are still room for what? Improvement. So all of these are to ensure that the auditor is able to gather as much information as possible as regards the what? The the performance of the organization. Okay? Now, another thing you also needs to look at is to look at if there has been change in the accounting system. For instance, maybe as of last year, they were using an accounting package, let's say Tally or QuickBooks, but this year they have upgraded to ERP. They are now using Sage ERP or they are using Microsoft Dynamics. So all of these are what the auditor will do. Okay, all of these are what the auditor will do to ensure that everything has been put into proper perspective. Then also the next thing is going to do is also to review whether there has been what we call assets, okay? Looking at the company's assets and other transactions. Now, for instance, if the company, if the organization, if the client is a bank that has over 350 branches all over the scattered all over the country, it will be unwise for the audit firms that they want to visit all the 350 branches. So what will they do? They are going to implement what we call audit sampling, or they do what we call risk-based approach. So they are going to focus on the key areas of the business and they obtain reports from other branches not visited by them. So at the end of the day, they are going to collate the two together and come up with a what? With a position, which is documented in their audit report. I hope that is clear. Does anybody have any question? Is there any question, any comment, any observation? Can we continue? So all of these are what the other activities the auditor will embark upon to be able to understand how the business operates, then at the end of the day, be able to come up with an audit report that represents the true position of the organization, that present the true and fair position of the what of the organization. Now, after doing all of this, the auditor will come up with a document known as what? Audit Planning Memorandum, or we call it Audit Strategy Memorandum. So what does this document contain? This Audit Planning Memorandum, Audit Strategy Memorandum contains information, the planning activities that will be embarked upon during the audit engagement. It is a document that contains the planning activities that will be embarked upon during the audit engagement. We call it Audit Planning Memorandum. Okay? Now, the Audit Planning Memorandum is set out or is designed or is developed to achieve the following objective. Okay? Number one, the essence of the audit planning is to be able to see that the auditor has been able to cover up all the areas of the business. Number two is to be able for the auditor able to plan adequately towards the audit to know that, oh, we need X amount of staff, we need this amount of this, we need X amount of resources. The auditor will be able to plan adequately. We will not have missed out on any key areas. So let's look at some of those information that are contained in the audit planning memorandum. The first thing, one of them is what we call the terms of engagement. So the audit planning memorandum will contain what we call the letter of engagement. Like I said, the letter of engagement or the engagement letter needs to be revised annually. It's not like when you prepare this year, is that what you're going to keep using forever? No, it must be revised annually because within the last audit period, there must have been some changes, and those changes must reflect in the audit engagement letter. So if you don't revise it every year, there are every possibility that there are some areas that will not be covered due to the updates or changes within the business environment. Number two, there's what we call audit risk areas. Now, in every business, you have some areas that are very strategic, that if they are exposed to any risk at all, it could bring about the end of such business. So that is why the auditor must be able to identify those key areas of the business and focus on those areas when they are doing the audit. And that is what we know as what? The risk-based approach, focusing on the risk areas of the business that are so strategic to the organization that should anything happen to the organization, the organization may crumble. Okay? Another thing that also needs to be contained in the audit plan memorandum is to look at have what we call like a catalog of all the assets and liabilities of the organization. Okay? So you must ensure that all the assets and liabilities of the organization are what have been captured. So for instance, you need to look at the asset register to see that all the additions have captured, all disposals have been captured, all revalued assets have been captured. All of these we need to be looked at. And they are always contained in the audit planning memorandum. Like I said, is a document that contains all the planning activities to be carried out by an auditor during audit engagement. We call it audit planning memorandum. Okay. The other thing that also be contained in that document is what we call the presence of the internal auditor. So the external auditor must be able to establish that the internal audit department within the organization is functioning. We have some internal departments that are what we call toothless bulldog. They are just existing just for formality's sake. So it's the duty of the external auditor to establish or evaluate if the internal audit department is actually existing for formality's sake or they are actually effective to drive the achievement of the organizational objective. Okay? So how will he establish that the internal department is functional? Number one, he looks at the the competency of the internal auditor. You look at the background. What knowledge does the person have? Does the person have an accounting background, or the person is coming from another field or discipline, like psychology or from religious studies? Does the person have, is the person inclined to financial analysis? So all of that is what's going to, that's first thing. That is the competence of the internal auditor. The second, you look at the um, the implementation of the observations or recommendations raised by the internal department. Now, let's say in a year, the internal audit department raises 10 recommendations in a year. Now, you now find out that out of this recommendation, only one has been implemented throughout the whole year. That shows that the internal department is not pulling its weight or the internal audit department is not effective. So that's what, so if he discovers that the internal department is not effective, what the auditor will do is to set aside the internal department and carry out the engagement both as an internal audit and as an external auditor. He will perform the dual roles. Okay, he will perform the dual roles because he needs to be sure because there are times where we need to rely on the work of the internal auditors. And if we cannot place reliance on the work of the internal auditor, then there is no need. So what you just need to, you just advise the client that you will perform the role of internal auditors and set aside the existing internal control, the internal audit department. And that means that they will charge what additional audit fee in that regard. Okay. Then the next thing is also needs to put in the audit planning memorandum is whether it's going to make use of specialists. Who are specialists? Another name for specialists are what we call experts. Another name for specialists are what we call what? Experts. Who is who is an expert? According to IAC 620, an expert is someone that has competence in other fields outside accounting and audit. An expert is someone that has competence in other fields outside accounting and audit. We call the person an expert. You can see the way I define expert. If you have not heard of expert before, that definition I gave, there's no how you would have been able to come up with such definition. You'd have been saying that an expert is somebody that is efficient, that knows his work, that's professional. That's what you'll be saying. So there is a need for us to learn all those terminologies used in auditing. So an expert, I always tell us that the way we talk or we discuss in audit is not the same way you discuss when you are talking about English. So English meaning of expert is not the same thing as the audit meaning of expert. Expert in English is it has a different meaning, different from what I just explained as expert in audit. So an expert is someone that has competence in other field outside accounting and audit. Okay? Because it's not when you have started the engagement, it's not that, oh, I think I need people that are experts. Examples of experts, we look at that in chapter 1 when I talked about the what do I call those people? The practitioner. Okay? A practitioner is likened to an expert. So what I'm saying is that you want to go and audit a client that's into real estate. External auditors are not trained to understand how to value items or assets in real estate. They go with people that have been trained in that area. So that means they will be going with people like architects or quantity surveyors. Ask any auditor how many blocks do you need to complete a building? Let's say a three-bedroom flat. Auditor can never know because that is not part of our training. But ask a quantity surveyor, how many blocks do I need to build a four-bedroom flat? The quantity surveyor will tell you the exact amount of blocks that you need. And the person will be perfect. Because that is what they have been trained to do. So that is why audit firms, the big four, they have their experts in-house. They have their what? They have their experts in-house. While the small medium audit firm, they source for their experts. Okay, so when they are going for the small medium audit, when they are going for any audit, they have to ensure that they get those experts ready so that they go along with them. They don't have them in now because they cannot afford to pay them. But the big four, they have all those experts in now, surveyors, architects, engineers. Go to any big four, you find them there. They are not accountants, but what they are doing is that they are working as what? Experts. Okay? Then also, in that audit plan memorandum, it will contain the audit approach. So the audit approach, like I said, is based on the preliminary audit assessment. The auditor will be able to ascertain what type of method do we want to use. We are going to talk, and that's what we are going to talk about in this chapter. We'll soon be going there now. What type of what type of strategy do we want to apply? Then in the also in the audit planning memorandum, it contains a timetable. You need to know because I told you I have explained that to us that in practice management, right? That you have the pay auditors per hour. Their work is time bound. And because their work is time bound, they must work with time. So they have a timetable. So the timetable of staff that is required, number of hours they are going to spend, the area they are going to cover. All of these are contained in that what? In that timetable. Please mute your mic, Adeoyo. Adeoyo, mute your mic, please.
Oh, sorry, sir.
You understand what I'm saying? So that timetable is very critical because is the best way to manage the duration they are going to spend in an audit engagement. Then it also contains the list of staff that they are going to require. It's not when you get to the field and say that, oh, I think I need two extra staff. Doesn't look like that. That's why I say that extra auditors are always what? Very, very detailed. They are very, very what? Detailed. So they will have done their planning very well before they set out from their audit firm. The number of staff they are going to need is already known, and the name and their list will be contained in that audit planning memorandum. Another thing that's also contained in the audit planning memorandum is the fee. How much they want to charge. In chapter 5, when we look at practice management, we have explained how to determine the audit fee. So whatever fee that they are going to charge, how they have come about it, they are going to also detail it in the audit planning memorandum. Okay? Like when you have the audit manager, their fees will not be the same as audit intern. So all of this will be documented. Okay? So these are some of the information that are contained in what we call the audit planning memorandum. Another name for this audit planning memorandum is what we call audit strategy memorandum. It's the same. Please, they can use them interchangeably in the exam. Do not be distracted and say, oh, we don't know of this one. It's the same thing. Okay? Now, what you also need to understand is that when you are trying to carry out an audit engagement, it's expedient that you gain understanding of the client business. ISA 315 that talks about trying to understand the client business in the area of business risk explains that there are certain things that you need to know, or that there are certain things you need to do for you to gain knowledge about how the business operates. The first thing you need to do before you audit any client, you must pay a personal visit to the client premises. Because you cannot audit what you don't know or what you don't understand. You have to be there to see things for there that this company actually exists. It's not a company that is in limbo. Number two, the auditor can also gain understanding or gain knowledge about the organization by reading the what? The minutes of meetings. Because in meetings, they jot down. Their jottings are what we call minutes. So if the auditor can be presented with those minutes of meeting, he can get some idea of how certain decisions have been made within the organization. Number three, another way to gain knowledge about the client business is to review the previous audit file. So you see that anytime external auditors want to audit any client, even though they are the one that audited the client last year, they start from where they stopped last year. There are instances when they make some recommendations that they were not able to implement last year. So when they are starting this year, they will start from where they stopped last year. They need to have a proper understanding of how the business has transformed. The other thing also, the auditor is to do what? Is to lay hands on some other documents that might be important or that might provide clearer information or better information on how the business operates. Sometimes you need to look at the journals that pertains to the industry where the business or the client business operates. For instance, if you look at the banking system, CBN, I don't know why they still have it now, but sometime in the past, they have what we call the bullion magazine. The Below magazine contains all the events or the activities that have happened between the CBN and its bankers over the couple of time, whether quarterly or half yearly. If you go to real estate, there's a journal they call Castle, Castles. So that Castles give an insight into how to sell or the prices you can put on your assets, on your buildings. depending on the area where they are located in any part of the country. So by laying hands on some of these documents, they will give the auditor insight as to how the industry or the sector operates. Okay. Then also there will be need for the auditor to make himself available by asking questions from the staff, from the client. Ask questions. Okay. But when you interview them, you ask questions. Okay. By answering questions, you'll be able to also add to your knowledge about how the client business operates. Okay. So when the auditor, when the auditor is trying to draw up his audit strategy, the auditor should have this at the back of his mind. Number one, his responsibility in accordance with the terms of engagement. Remember in chapter 2, we look at auditor's responsibility as regards um, client business, which is number one, to ensure that financial statements are prepared in line with applicable financial regulatory framework. Then number two is to ensure that the statement of financial position and the source documents, they agree. Then every other one, talking about the to qualify to do this are now coming. Then the next thing he needs to also have at the back of his mind is the nature of the client business. He must understand what sector does the client operate. Is it a telecom sector? Is it an IT sector? Is it an agri sector? You need to establish that because every sector have their own peculiarities. They also need to establish the nature and significance of items in the year's account. So that means that you should be able to look at the financial statement and look at those areas that serve as what indicators whether the organization is working perfectly or not. Okay? You look at that. For instance, if you're auditing a bank now, the way the financial position, so the financial position is arranged in the banking sector or banking industry is not the same way that it's arranged in other sectors. For instance, in a bank, if you have forgotten, let me remind us, they arrange the items in the same financial position in the order of what? Their liquidity. Rather than for them to start with non-current asset, they will start with what? With bank and cash. And it goes down like that. Okay? Then the next thing he also needs to also have in the back of his mind is the principal features of the client accounting system to be sure that the internal control system and the accounting system that have been put in place are what? Are achieving the needed expectation or objective. Because if the accounting internal control system is porous or is weak, then it gives room for what? For fraud or fraudulent transactions. So the auditor must be able to have all this at the back of his mind. And also, he needs to also have at the back of his mind what kind of system do they have? Is it a manually operated system or a computer-based information system that they use? Because the approach will differ when you are using a manual system or when you are using a computer-based information system. So it is the auditor's responsibility to ensure that all of these are put into what? Into consideration. Okay? But this one we have a familiarization with the client business is similar to what we discussed above. So you don't need to bother yourself with it. It's the same thing, right? Now let's go on. Now let's look at the all of these are still talking about I've explained earlier, so you don't need to bother yourself. Okay, so let's just go on. They are part of what I've discussed earlier, so don't need to bother yourself. This is the same thing. Still part of it, all what I've discussed earlier. Okay. Mm. I've explained management letter. Okay. I've talked about that. So I'll come back to this one later. The controls. Okay. Internal can come back to that later. So let's continue. Now, next thing you need to look at is the type of audit approach that we have. Types of audit approach that we have. Okay, there are four types of audit approach. The first one is called what? The first one is called what? Statement of financial position audit approach. Statement of financial position audit approach. And this is the oldest type of audit approach. It's usually referred to as what? As the traditional audit approach, but that was the first to exist. Now, this approach really make use of what we call verification and what? Vouching. This approach make use of what we call what? Verification and what? Vouching. That is, when you're using this approach is suitable for business that are just starting or business that are small because you must check everything for business that are small and business that are just starting. You must check everything. Later, we need to check all the transactions, check all the vouchers, check everything. You cannot apply something in this regard for business that are just starting. And also, this approach is also used when you are using a manually operated system. So a manually operated system, you cannot afford not to check everything because there are high chances of what? Fraud or poor accounting record keeping. So therefore, we need to check everything in this regard. And for the assets that they have, therefore, we need to what? Verify that those assets actually exist. Okay? Someone is asking a question here. What are the signs that are visible to the external auditor during his review before he concludes that the internal audit is not technically competent? I've explained that. When you are just joining us, I did explain that. Okay. And I said, I'm not going to go back, I'm not going to deviate from what I've said. What I said is that the external auditor will test the competence of the internal audit department, the head of the department. What competence does the person have? Is the person inclined to financial accounting or financial reporting? Or does the person have degree or competence in area of accounting? Or is the person a child accountant? Or the person is is a graduate of religious studies or zoology, and he has not taken time to take up diploma courses in financial reporting or financial accounting. Okay. The number two, the external auditor will also look at the report that the internal auditor makes or develop or write at the end of the month or at the end of the year. So in the report, there will be some recommendations. So if in the report, you have like 10 recommendations for a whole year, and at the end of the year, only one of those recommendations have been implemented. That shows that the internal department is very weak. So in that instance, the external auditor will term it as what? Not competent. Technically not competent to rely on the work of the internal auditor. So they are going to set the internal audit department aside. I hope I'll be able to answer your question. Very right. Okay, so let's go back to I was explaining substantive testing audit approach. So I said the method you use for this kind of audit approach is basically vouching and what? Verification. That is, you must check everything. And I said that this is mostly used for business that are just starting, or business that are small, or business that are run manually. Okay, that's when you make use of this approach. You cannot utilize this approach for businesses that are already established, that are like banks. You cannot do that. Otherwise, you are going to waste a lot of time and resources. Okay? And also, you make use of this approach when there's a weak internal control over financial reporting. What that means is that the internal control system is very weak, very poor. So you need to check everything. Okay? That is what those are the instances where you make use of the substantive testing audit approach. I hope that is clear. If you have any question, please ask. The second approach is what we call the statement of financial position audit approach. Statement of financial position audit approach. Now, this approach is the next, okay? After they've utilized the substantive testing audit approach for a while, they now evolved to what we call statement of financial position audit approach. Now, this approach makes use of assertions. They make use of what? Financial statement assertions. We are going to talk more about assertions in chapter 8, audit evidence. Let me just know what you mean by assertions. Now, assertions are statements made by management that the financial statements presented to the auditor do not contain any material misstatement. These are declaration statements made by management to the auditor, confirming that the financial statement presented to the auditor do not contain any material misstatement. We call it assertion. And there are three types of assertions. We have assertion based on transactions and events. You have assertion based on account balances. And you have assertion based on presentation and disclosure. So what that implies is that when you're using this approach, statements of financial business audit approach, what it means is that the auditor will focus more on the statement of financial position. That is, we look at the assets, we look at the liabilities, we look at the equity, and from there, we can tell whether the company is meeting up with their um, performance in terms of growth or whether they are declining as an organization. That's it is called statement of financial position. That statement will show, yes, iPhone, raise your hand. iPhone, ask your question, please. I didn't see.
Sir, the first approach you,
Yes, I'm with
the
you.
first approach you said was statement
Yes,
of financial position.
yes,
Can
yes.
you hear me, sir?
I can hear you loud and clear.
The first approach you said was statement of financial position. And you are
Audit
saying
approach,
the
yes.
second one too is statement of financial.
No, the first one is substantive testing audit approach.
Okay.
Do you understand? Thank you. Substantive testing audit approach was the first one. The second one is statement of financial position audit approach. Hope is clear.
Yes, sir, it's clear. Thank
All right, all right. So for this one, I was talking about this, right? What I'm saying here is this: for you to use this approach, right? First of all, you also have a weak internal control system over financial reporting. Weak internal control over financial reporting will also be applicable in this instance. All right. Then what that means is that this one is just an advanced level of the substantive testing audit approach. Okay. Hope we are getting it. Same financial position audit approach. So this one I said you make use of assertion. Let me explain. So you look at the same financial position. The same financial position contains assets, liabilities, and equity. So you look at these three. If you look at this financial position, some of the information contained therein, they are also contained in the statement of profit or loss, other comprehensible income. They are similar. I hope you know. Your net profit in your statement of profit or loss, other comprehensible income, is what we refer to what as your reserve or retained earnings in your statement of financial position. Right or wrong? Yes, right? Your closing inventory in statement of profit or loss is your inventory balance in your statement of financial position. Hope you are getting it. So some of them they have resemblance, okay? They are similar. So what the auditor will now focus on is to look at the statement of financial position critically and use it to evaluate whether the company is performing or not. Okay. Now, another thing he needs to do is to look at that what we call the assertion. The auditor will make use of what? Assertions. So when you're looking at those assertions, you'll be able to verify, for instance, assets, non-current assets. The auditor will say, okay, let me verify whether those assets actually exist. Because the assets can be falsified. So later we check whether those assets are what are, are actually in existence. Then the author will also check the cutoff for those transactions put into the statement of financial position. For instance, inventory, they must ensure that it does not pass a period that's supposed to be recorded. For instance, we are looking at statement of financial position. It's always the name of the title of that financial statement is called Statement of Financial Position as at 31st December, so and so period, or whatever period they have chosen. So the author will check closely that those periods that have been defined, that the cutoff meet up with those periods. That is, for instance, if you have chosen 31st December every year as a reporting period, what that means is that any transaction outside 31st December should not be included in your statement of financial position. I hope you understand. So these are some of the things the author will be checking. And like I said, you make use of this approach when you are looking, when you have a system that is also weak in terms of what internal control over financial reporting. Then number two, you are using this system when you have an hybrid kind of operation. You have some manual operations, you have some computer-based or computer-based operation. Okay, you use that approach as well. Then also, you make use of this approach for businesses that are small or medium. They are still trying to survive. Okay, you can use this approach, but they must have some form of what combined, that is both manual system and computer-based system. That is the second approach. The third approach is known as what? Risk-based audit approach. Risk-based audit approach. Now, risk-based audit approach is used in companies where you have what? When you have a system in place. Okay, you use this one when you have a what? A defined system, an effective internal control system. When you have a reliable accounting system, you make use of this approach, risk-based and internal risk-based approach. Also, this approach is the most advanced approach of all the four approaches. This is the most advanced approach. Okay, so what are the tools you use for this approach? You make use of what? Assumptions and estimates. You make use of what? Assumptions and estimate because you are using more of what? A futuristic information, what we call prospective financial information. In this approach, you make use of what? Futuristic information. That means that you are not looking at your business as it's operating as at now, but you're looking at how your business will continue to operate in the next 5, 10 years. You are looking into the future. And the only way you can look into the future is by making use of what? Estimate and what? Assumptions, which are contained in what we call the prospective financial information. Because for you to project into 5 years, that means you're going to make use of what? Forecast. By 2020, by 2030, we want to have reached $1 billion as a business in revenue. By 2029, we want to have done this, we have to have done that. All these are based on what? Forecast. And you know, forecast is based on what? Assumptions and what? Estimates. So as an organization, for you to be able to rely on forecast and estimates, that means your internal control system and your accounting system, they are what? Effective and efficient. Okay? Internal control system are what? Are effective and what? Efficient. Now, this approach also looks at other side of the business, the internal risk and the external risk. In this approach, you're going to look at how the business operates internally. What are the risks that, that impact the business negatively? For instance, if there's high labor turnover, for instance, I'm coming, let me reduce the. Can you hear me? Okay, I said that in organizations, we have what we call internal risk and external risk. Internal risks are risks that are within the organization control. For instance, when you have high labor turnover is an internal risk, it's not an external risk. That means there is something that is wrong with the company's policy that's making people to be employed, and after a while, they change employment. Okay? That means there are some factors, there are some things, there are some indicators that are making people to run and leave the organization. So that means the money needs to address that issue. Number two, we have what we call the external risk. External risks are risks that are outside the control of the organization. So, for instance, with the rate at which this petrol is going now, petrol has gone up again, right? And it's going to impact on businesses across board. The organization don't have control over it. But some organizations think that, okay, let's start giving our staff some sort of stipend as transport, just to cushion the effect of the transport cost on them. You cannot you cannot challenge government that government should reduce the prices of fuel. You can't. Okay? So that will mean that external risk. Then you now look at all these external internal risk, they are relating to what? The business risk of the organization. Okay? Then we now look at the other risk, the risk base, that is the organization as an organization that is established. The auditor, we want to focus on those areas that are very, very strategic to the survival of the organization. Later, we want to concentrate, focus more on those areas that are key to the organization. It's just that when you want to go and audit a bank now, bank, there are several things that you can do in a bank, right? But you agree with me that when the auditors go to audit a bank, they focus more on the key risks of the bank. The most important risk in a bank? Is fund, deposit, money. So the auditor is going to audit a bank. We focus on the money in the bank, that the money has not been stolen or pilfered. In a bank, you have assets also. Yes, you have non-current assets. Yes, you have other things. Yes, but you see that most times the auditor will focus on what? The money that is in the account of depositors are what? Are safe. Because that is the essence where they are in business. If they cannot keep if your money is no longer safe in a bank, you don't need the bank should not exist any longer. So it's the work of the auditor to check that the investor's money in this bank is what? Is effective. I mean, is safe and secured. Hope you are getting it. So that is what we mean by risk-based approach. It's looking at it from two sides, the business risk and the risk-based approach. The risk-based approach is the aspect where the auditor will concentrate on the key areas of the business. Now, this approach is mostly used by companies that are what? That are big, already established, large organizations, like multinationals. They are the one that make use of this. An instance now is that you are looking at fuel now. Fuel has gone up. But those companies that are into manufacturing of motor vehicles, like Kia Motors, right? Stallion Motors, Dangote Pojo Nigeria Limited, Innocent Vehicle Manufacturing, Innocent Vehicle Motors, and the likes of all those manufacturing companies, car manufacturing companies in Nigeria. Now that the fuel has gone up, most of them now they are converting to what? They are converting to what? Compressed natural gas, CNG vehicles. Because that is cheaper than using what? Fuel, PMS, pure motor spirit. So for businesses like that, they have to be what? Strategic in their thinking. Because a time will come when this fuel will no longer be available. So you need to look at other areas. Like you see in US, they have what we call Tesla cars that is run on what? That is run on electric, does not run on fuel. We cannot deploy that in Nigeria yet because our light is not yet stable. The national grid has collapsed like 6 times in this year alone. So imagine you are driving an electric vehicle and you are traveling from here to Ibadan and you're supposed to have charged your car for about 3 or 4 hours. But the light that you had could only charge your car for 2 hours before you departed for the journey. Now you are on your way to Shagam, coupled with heavy traffic on the road. You are on your way to Ibadan, but you are at Shagamu now because you did not charge your car to the fullest. Your car was about 70%. When you got to Shagam, the energy ran out, and it was in the night that you are traveling, or it was in the early in the morning that you are traveling. How would you have survived? You understand what I'm saying? That's why I said Nigeria is not right for what? Electric vehicles. But we are using what we call compressed natural gas, CNG vehicles. That means that a kind of is similar to the kind of gas we used to cook, but is different in a way. It has been compressed in a way that rather than for you to be running on fuel, you are going to you are going to design the automobile in such a way that it will run on what? On that natural gas, compressed natural gas, CNG. So as a business, you need to be forward-looking. If you want to deploy a risk-based approach, it's not for small companies. Innocent vehicle manufacturing, they started manufacturing vehicles that run on what? CNG, compressed natural gas. And there are some cars that have been manufactured now that are manufactured and they use CNG. In fact, there are keke napep now that are manufactured that make use of what? CNG. Example is this guy's automobile company. What's his name? Obi Kubana. He has a company that they manufacture keke napep. And the keke napep says that they are running on what? CNG. So these are companies that are forward-looking. It's not for companies that are small. Because to run such companies, you need a lot of money. And the only approach they can utilize is what we call the risk-based approach. I hope we are together. So that is what we mean by keep a risk-based approach. And I've explained where you use it. You use it when you are looking at companies that are what? That are big, large companies. Okay, we'll come back to this one. Let's go to the next one. System-based approach. That's the last one. I've talked about substantive testing audit approach. I've talked about system of financial position audit approach. I just finished talking about risk-based audit approach, right? The last one is called what? System-based audit approach. We'll come back to the explain this one later, eh? Don't worry. System-based audit approach. This is it here. Now, system-based audit approach is the third one. I told you that the last one, which is the best, is the risk-based approach. But the one before the risk-based approach is what we call the system-based audit approach. Now, what does this mean? This is an approach that is based essentially on what? The effectiveness and efficiency of the client's internal control system, basically. So for you to use this audit approach, system-based audit approach, your internal control system must be what? Must be efficient and effective. And that will bring us to explain what we mean by what? Internal control system. Now, internal control system are what? Are sets of controls, financial or otherwise. They are set of controls, financial or otherwise, established by management to ensure that the business is run in an effective and efficient manner, to safeguard assets, and to ensure that the business objective are achieved. That is internal control system. There are sets of controls, financial or otherwise, established by management to ensure that the business is run in an efficient and effective manner, to safeguard assets, and to ensure that the business objectives are what are achieved. That is internal control system. Now, for you to use internal control system, for you to assess or evaluate that your internal control system is efficient and effective, then you need to look at the component of a good internal control system. So for you to say you have a good internal control system, number one, you must have what we call the control environment. What is the control environment? The control environment is that area that is being controlled by the management and those charged with governance. That is the board of directors and management. They are the ones that control this environment. They ensure that they put in place the right policies, procedures, and system. Okay? They dictate how the organization should run. They dictate the goal and objective of the organization. We call it what? The control environment. Number two, we have the entities risk assessment. Now, the entities risk assessment is that aspect that is also being controlled by those charged with governance, that is board of directors and management, that talks about how the organization should identify their risk and decide on how to manage or mitigate those risks. You have been taught before that the risk cannot be eliminated, but can only be what? Mitigated. So the those type of governance responsibility is able to what? Identify those risks and try to do what? Mitigate those risks. Okay? So another component of a good internal system is that they must have what? An information system. That is, the information system should be such that the financial reporting objectives are being achieved. That is, there is proper documentation, there is proper accountability, and above all, there is what? There are procedures, there are data, there are people of integrity working on those transactions so as to ensure that the financial reporting objectives are what? Are achieved. Then number four, you have what we call the control activities. These are activities that are designed to ensure the achievement of the corporate objectives. These are a set of activities that are designed to ensure that the goal of the organization are achieved. For instance, the kind of what we call what? Appraiser, performance review. What was the say last month? What does it say this month? What was your performance of the staff last year? What's the performance of the staff this year? They look at ensuring, looking at the information process, information process in the organization. How fast? Last year, how was the processing of information? How accurate or how fast was it compared to this year? What are the controls they have put in place? All of this we have to do with what the control activities. Then you have the fifth one, which is what? Control, monitoring of controls. This has to do with putting in place a system that checks other system. This control has to do with what? A system, putting in place a system by management to check other systems within the organization. So most time we talk about monitoring of control, we are talking about the establishment of the internal audit or internal control department to ensure that all other departments within the organization, they are achieving their what? Their set objective. That they are doing what? They are achieving their what? Their set objectives. So we call it what? Monitoring of what? Controls. So internal audit department will evaluate every other department, account, finance, HR, admin, IT, legal. They will evaluate everybody that they are achieving the reason for setting up those departments. For instance, payroll, HR, are they paying salary as at when due? Account, are they presenting the financial account as at when due with accurate information? IT, are the internet facility, internet company's asset, information asset, how secured are they? All of these are what the internal control department will be focusing on. So those are the five components of a good internal control system. Any question, any comment, any observation. We go to the next one, types of internal control system. And types of internal control system is represented by mnemonics I call Papa Musab. Mnemonics I call what? Papa Musab. This is it here. Papa Musab, you seen it? So, it's like you always see in my class, I try to make learning to be fun, right? So those Papa Musab is represented by PAPAMOSSAB. That is Papa Musab. So I start with the first one, the first P there, personnel control. This control is a control that is put in place to ensure that only competent and suitable staff are engaged. Only competent and suitable staff are engaged, devoid of what? Mediocrity and what? Favoritism. Devoid of what? Mediocrity and what? Favoritism. That is, you must ensure you hire the right person for the position. Don't hire somebody because it's from your tribe, or is your brother, or is your religious faith partner. Hire people because they are competent, they can do the job, they can deliver. Number two, arithmetic and accounting control. And you must ensure that all your transactions are checked and they are correctly posted into the system. That means you don't double post, you don't transpose, you post the right amount into the system. That's what we call what? Arithmetic and accounting control. Those controls must exist. Number two control that must exist is physical control. These are controls that are designed to safeguard what? All the assets, company's assets. So example, CCTV, security, locks and key, biometrics. These are examples of what? Physical controls. You have authorization and approval controls. These are controls that ensure that all transactions are duly authorized and approved. So that means you don't just treat any transaction. It has not been approved if you don't make payments. You have management controls. These are controls put in place by management to ensure that the internal controls that to ensure that the organizational objectives are being achieved. These are controls put in place by management to ensure that the corporate objectives are being what? Achieved. It's called management control. That's why they set up the internal audit department to look at other departments, whether they are working in line with the what? The objective of the organization. Then we have organizational controls, otherwise known as what? Organogram. These are controls that ensures the lines of reporting and also looks at what? Allocation of responsibilities to staff along the what? The line of reporting. So that means that an account department should have staff that reports to from the account officer to the CFO. And the on no account should the account officer be reporting to head of HR. That does not align. The account officer should report to the what? To the CFO, but not to the head of HR. You understand what I'm saying? That's what we mean by what? Organizational control. You have supervisory control. These are controls to ensure that all transactions, all activity are properly checked and processed before they are what? Before they are approved. These are controls that are put in place that all activities and transactions are properly what? Checked, monitored, okay? Before they are what? Before they are what? Processed or approved. Before the supervisory control. For instance, the CFO will give assignments to, I mean, the MD will give assignment to the CFO. CFO will give the assignment to the uh, account manager, okay? And the account manager will now do the work of the CFO based on the guidelines. Then, before he submit to the MD that gave the assignment to the CFO will review it properly. That review done by the CFO is a form of what? Supervisory control. That whatever is given is presented to the management is not does not include errors, or that is the whatever is presented to management is devoid of what? Errors. All right. Then the next one, we have segregation of duty. These are controls that ensure that no one person initiates and completes a transaction. These are controls that ensure that no one person initiates and what complete a transaction. Hope you are getting it. Then we have the next one, which we call acknowledgement of performance. Acknowledgement of performance. These are controls that ensures that all transactions are what? Are properly what? Signed. That is, they are pen signatures, initials. Okay? Stamp. Time stamp to all transactions for easy what? For easy accountability. Ease of accountability. Okay? Acknowledgement of performance. Then the last one is called budgetary control. Budgetary controls. These are controls that are put in place to ensure that managers utilize resources at their what? At their disposal for the in the most objective or judicious manner. These are controls that ensures that managers utilize resources at their disposal in the most effective or judicious manner. They don't waste resources. That's what it means. So you want to spend, you want to procure anything. If it has not been budgeted for, you cannot incur that cost. Hope you are getting it. Any question? So that's Papa Musab. Any question? Any question? Any comment? Any observation? Are we all together? Are we enjoying it? Okay. So before we go on to the next, so let's go to the other one I made mention of before. I talked about basic control. Okay. Yeah, somebody raised his hand or somebody is asking a question. Yes, any question? Let me see. Okay, without any question, I'm waiting. Do you have any question? Please speak up. All right. Put it in the chat box. Do you have any question? Now, I want to talk about this a little. Okay. We are looking at internal control. Now, internal control, because we are looking at internal control has to do with ensuring that there is proper accountability, proper documentation. That is internal control. Okay. And how do you ensure a good internal control? How do you evaluate whether internal control is effective and efficient? You look at this area, you look at the basic controls. Okay. Now, basic controls are controls that are built into the system. Okay. Which operate all the time and in respect of all transactions. They are already built into the system. For instance, if you have not um if you have not received any item, you procured some item. If you have not received it into the store, you cannot issue it out. You cannot buy something off the market and start using immediately. No. Store must receive it. Those are basic controls that we are talking about. Okay. Another example is called basic control. Is when you pre-number your document. For instance, your requisition, purchase requisition, you pre-number it so that nobody will tear it off, will tear some part of it and use it for fraudulent transaction. Those are what we call what? Basic controls. Okay? And there's what we call discipline over basic controls. So what that means is that these are controls that are established as checks over basic control on which operate only occasionally or as often as management may desire. Examples of basic controls include are what? Routine stock checks. Internet will just say, let me go and do impromptu visits to some of the departments without announcing that they are coming, just to check that they are doing what is right. Because ordinarily, if you are doing what is right, whether you are being monitored, you are being supervised or not, you keep doing that right thing. That's the essence. So they don't want to check that, oh, the organization, they are doing the right thing all the time. Okay, I've talked about management letter. I've talked about that. Okay, I've talked about that before. Yes, no, everything is fine now. So let's go on to where we stopped. Any question? No question, right? Someone is asking a question. Okay. I don't have any questions, sir. I only reply to what you said earlier. Okay, okay, that's fine. No problem, Maziat. Maziat. Okay, let's continue. Hope we are all enjoying the class. Mhm. We have looked at types of internal control system, Papa Musab. I hope everybody is clear with that. Okay. Now, use of internal control system by auditors. When does auditor use internal control? What is the importance of internal control with the auditors? Now, when internal control, what it does to the auditor, external auditors essentially are this. Number one, it makes it easier for them to identify types of potential misstatement. So by evaluating the internal control system, they can detect if the account system is what contains some material misstatement, and they quickly try to address the area or the issue. Number two, they use internal control system to evaluate the risk of what material misstatement. I've talked about that risk of material misstatement. There are misstatements, there are material misstatements. Misstatements are allowable. Okay, for instance, because of um rounding up of numbers or figures in an account. For instance, you want to write 3,000, 3,286. But because of that, you put 3,200. You understand what I'm saying? Those are misstatements. Okay, they can pass as what misstatement. But material misstatement is when you're supposed to write 300,000 or you're supposed to write 3 million. You now went and put 300,000. Those are material misstatements. Those ones are not possible and are not allowable. So these are the material misstatements that the internal control system what we check. Number three, the 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 effectiveness of the internal control system is dependent on during audit whether the external auditors will carry out further audit procedures. Let me explain. Now, the external auditors is checking for procurement. He's looking at the purchases schedule and he stumbled on a figure and he now looks at the narration in the purchase ledger or GL, purchase GL, and sees that the narration is not complete. That let me get the voucher itself. Let me lay hands on that purchase voucher itself. He looks at the purchase voucher, he sees that the information is not complete again. Like, let me go and see the assets. So what that means is that he's adding up to his what? Audit procedure. He's supposed to look at the document and check whether the document is correct, is complete. But from what he has evaluated, he saw that document is not correct. That's why he's going further to go and check what? The physical verification. That's why he's embarking on what? Physical verification. So internal audit, the effect of the internal control system helps the internal auditors to identify types of types of potential misstatements, looks at factors that affect the risk of material misstatement, and the nature, timing, and extent of what further audit procedures. All right. Then the next thing you need to look at is communication on internal control. Now, the communication on internal control rests with communication on internal control rests with what? The management. It's only the management that should be able to that should be communicated on whatever happens with the internal control system. That is why the management letter is usually addressed to the management. Okay? So some of the things that will be contained in that management letter is what we call the approach and scope of the audit. What approach and scope does the auditor want to use? Is he using the statement of financial position audit approach? Is he using the risk-based approach? Is he using the system-based approach? It will be communicated. Selection of and changes in accounting policies. If there has been changes in accounting policy, it will also be communicated there. If there are audit adjustments that should have a material effect on the entity's financial statement, will also be communicated. For instance, there are some directors and emoluments that need to be what? To be reevaluated or to be readjusted. The director will need to communicate and the reason why they are doing it, the effect is going to have on the financial statement. Then if there is any material uncertainty that may cast significant doubt about the going concern of the entity, every business is supposed to continue in exist, is supposed to continue as a going concern. If there are any concerns that may cast or that may cause going concern issue for the organization. Okay, you say, someone is asking a question here. Are you saying internal control can overlook immaterial misstatement? No, you don't call it material, don't call it immaterial misstatement. Better framed. Are you saying that the internal auditor can overlook misstatement? There are two types of misstatement. Either you have misstatement or you have material misstatement. The internal control system might overlook misstatement. It's not supposed to do that, right? But that can be allowed. But material misstatement cannot be allowed. That is the essence of putting in place internal control system. To look at what? To ensure there is no risk of material misstatement. Go and check. It's what you have there. Misstatement can happen, can be based on your judgment. Another type of a misstatement is this, right? You're supposed to use reducing balancing method. You are using straight line method. When you use straight line method, you use reducing balancing method, you're not going to arrive at the same depreciation, right? But you have done depreciation. Do you understand? You have been able to do what? You have been able to look at your assets in a way. So that could be a misstatement. Do you understand what I'm saying? I hope I'm able to clarify. So I'm not saying that it is allowed, but misstatements are can be pardonable. But material misstatement is not pardonable. It shouldn't happen. I hope it's clear, erudite. Okay, thank you. So as I was saying, so these are the other things you are going to communicate in the to those charged with governance in the management letter and where there are material weaknesses in the internal control. I've started examples before. For instance, they refuse to carry out bank consolidation statement. They don't prepare it. They don't do stock count. All of these are what? Material weaknesses in internal control system. Okay? Then if there are concerns as to the integrities of management or management integrity, that could also be a factor. When there are integrity related issues about the management, because management is supposed to have integrity at all times. When the auditor is doubting the integrity, or when there is a vote of no confidence on the integrity, then that means that there's an issue. All right. I hope that is clear. Okay, so that's all about that. So let's look at third party interested in communication on to those child with governance. What this one is saying here is that sometimes third parties, government, investors may be interested in internal control system, weaknesses in internal control system. According to the auditing standard ISA 260 that talks about this, it's ISA 260 that talks about this particular one. Those that should be that the internal weaknesses in internal control system should be communicated with. ISA 260 talks about those that should be communicated with what? Weaknesses in internal control. It states that it is not the responsibility of third parties to be communicated on weaknesses in internal control system. The communication should go basically to the what? To the management or those charged with governance. But if there is a need to communicate to third party, the external auditor should approve, okay? The external auditor should approve such to be what? To be done. The external auditor should approve that such should be what? Should be done. So if they don't get the management, if they don't get the external auditor's consent, they should not disclose any information to the third party. You can see it here. If not, must if must not be disclosed to a third party or quoted or referred to without the written consent of the auditor. No responsibility is assumed by the auditor to any other person. See what I've said? It's just there. So I've summarized everything. Any question? Jubri, how do? Yeah, please mute your mic. Okay. So we go to the next one, which is I think that should be the very last one before we call it a day. Let's look at the threat or limitation to internal control system. What are those things that limit the achievement or the efficiency and effectiveness of internal control system? What are those things? Number one is management override. What's management override? When an already designed internal control system is set aside by management, you have a system in, for instance, you said that for every transaction above every payment above 1 million naira, they should use two signatories to the account. We're not saying that, oh, this 1 million naira, this one is my personal own as a manager or as a director. I want, I really don't want to sign it. I don't want two signatories to sign. That is called what? Management override. Or they say that for everything that must be brought into the organization, it should be documented, checked, and received at the store department. But the director is saying that, oh, that thing is for me. Don't take it to the store. Don't even. I know it's for the company. It's not personal. It's for the company. I don't want you to go to the store. Bring it to my office directly. That is management override. This weakens internal control system. Number two is human error. That is, everybody makes mistake. Nobody is free of mistake. No matter how meticulous you are, is normal. And this limits the effectiveness of internal control system. Another one is substance over form. Controls may appear to be well designed and still lack substance. For instance, you put in place controls to say that, oh, for you to secure this 1 million naira, you have to invest in what? 5 million naira worth of security before you can safeguard 1 million naira. That means that the control lacks what? Substance. Do you understand? You want to secure 1 million naira. That's it that for you to secure 1 million, you're going to spend 5 million naira to secure 1 million naira. That's what we mean by substance over form. That is, you are the control you are putting in place. The aim has already been defeated because why not leave the money in a way that someone can take it? Why spend 5 million naira to secure 1 million naira? It is not cost effective. Okay, that's what we mean. Then you have the next one, which we call failure to anticipate certain risk. Failure to anticipate certain risk. Now, what we mean by this is that management may fail to anticipate certain risks and thus fail to design and implement appropriate controls. For instance, in Nigeria, different animals have been used to perpetrate fraud in Nigeria. We have heard of snake that swallowed 36 million naira at Jamb office. We have heard of gorilla that swallowed 4 million naira at Kano Zoo. Recently, we heard of termite that ate up 2012 document on NSITF or so. Okay? And we have also heard of situations where they spend billions of naira to cut grasses. So, how do you spend billions of naira to cut grasses? What type of are the grasses planted on this in the sky? Or for the Kano Zoo, where the gorilla was said to have swallowed 4 million naira? Or is it for the snake that swallowed 36 million naira at JAM office? So that means that if you look at the internal control types of internal control system, Papa Musab, there's nothing there that talks about what animal control. Okay, that is at some point say that animal can swallow money. There's no point because it never anticipated that it will come to a point where animals can be used to perpetrate fraud. That's what we mean by inability to anticipate certain risks. The last one is called what? Collusion. Last one is called what? Collusion. Collusion is when two or more employees agree to circumvent internal control. So two people, they work in an organization. You have the internal department, you have the accounts department. Now the account department release money to one of their staff to go and procure items for the organization worth 50,000 naira. Now the guy bought the item, but he forgot to present receipt. Or another instance, he didn't even buy the item and he failed to retire. An internal auditor that's supposed to investigate that the reason for not retiring that amount of 50,000 naira decides to what? To look elsewhere. Because what? Both of them, they are what? They are friends. So what have they done? They have circumvented existing control based on what? Collusion. Okay? Or two people, the driver and the accountant. I mean, the driver and the accountant. The accountant is one that releases money to the driver to go and buy fuel. And the driver will now tell the accountant, see, I'm supposed to buy 50,000 worth of fuel. I'm going to buy 20,000. You win 30,000, I'm going to share it. That's collusion. Do you understand? So all these examples that I gave out now, they aim at what? Limiting the effectiveness and efficiency of internal control system within an organization. From management override to human error to substance over form to conflict of interest. Okay, I didn't explain conflict of interest. Conflict of interest is another threat to internal control system. This is where an employee has what? Divided loyalty. And I've used that example talking about an accountant and the internal audit department, where I said that he was given 50,000 naira to go and buy something. He did not buy it, he did not retire. The internal audit was supposed to prosecute or to investigate because they are friends. He decided to remain loyal to his friend at the expense of the organization. That is conflict of interest. Because if you go ahead to prosecute or to investigate and they found the other guy to have perpetrated fraud, that could cause their friendship. The friendship will not continue. You understand? So that is that. All right. They'll go to the last one, mitigating control. What we mean by this is that in an organization, you should have layers of internal control system such that if one layer is broken or is breached, there is another layer that compensates for that one that has been breached. So that at no point in time is the organization exposed to any form of what risk. That we call what mitigating controls. There must be additional controls in place. There must be additional procedures put in place to ensure that nothing goes wrong to ensure that there are no material misstatements, to ensure that there are no fraudulent transactions within the organization. That's why we call it of mitigating control, that is adding additional controls or putting up additional controls or implementing more controls. Okay? So all of these, so some of examples of those controls are what we call after the fact approval. Okay? For instance, internally they say that they stall operation, they stall transactions sometimes. They want to make some payment to the bank to procure some raw materials. They say we give it to internal auditor now, it will take 5 hours before they process it, before they finish evaluating. What would they do? What would they now do is that, okay, the auditor will just check, do some small checks, okay? And initial checks, then they say that you should go ahead and make the payment. After they have made the payment, the auditor will now do a review of the entire documentation to see that everything needed to have been done, all the necessary controls that needed to have been carried out has been what has been effected. We call it after the fact. Okay? Or we call surprise uh, checks, period surprise checks, like the one I talked about, surprise stock count. They normally do stock count at the end of the month. But in this instance, now they want to do stock count at the middle of the month, or they come on the 10th day of the month. It's like, we just did one on the first now. Don't worry, I just want to check something. All of these are what we examples of what we call mitigating controls. Okay? These are what we call what mitigating what controls. So so we are done with this. Does anybody have any question, any comment, any observation? Is there any question, comment, observation? Any question, comment, or observation? Are we good? So thank you for your time. I do appreciate, sincerely appreciate your time. I don't take this for granted. I do appreciate. Next week, by the grace of God, one of us will be around, okay? Either both of us might also be around. That is Mayowa and myself will be around next week by the grace of God. Please bear with us, okay? Um, I'm going to send us questions that relate to the topic that we have just treated now, this chapter 6, audit approach. Please endeavor to practice more past questions. It's for your own good. For you to understand how the audit exam is. Okay, simulate yourself towards the exam. That is, practice as many questions as possible. Okay, it will help you. It will do a whole lot of good. There's nothing difficult in audit. I can tell you. But there's a technique. There are techniques you need to follow. If you don't follow those techniques, it will not. It might not turn out the way it's supposed to be. But I'm assuring us that if you follow those techniques, and that's what you are trying to do, put you people on the right path, so that you go for this examination and come out successful. So please, any question being sent, please endeavor to attend them. I'll send you us questions tomorrow, if not this evening. I'm going to send us questions, past questions. Please attend those questions on your own. And if you have any concern on any topic that we have done so far, or that we are about to do, please feel free to get across to me. I'm available 24/7. You cannot reach me by phone, by calling. You can reach me by WhatsApp. You have my WhatsApp number. Please, thank you so much. Thank you so much. I wish us all the best. So, in the absence of any other question, the class is hereby adjourned till next week. Have a good night. Okay? Thank you so much.